Imagine you decide to throw the biggest dinner party of your life. Not for 20 people, for thousands. You sell tickets months in advance, and people pay full price, sight unseen, because the menu sounds incredible. You take that money and you buy the ingredients early because prices are only going up and you don't want to be caught short. Crates of fish, cases of produce, everything a five-star kitchen would need. There's just one small detail you forgot to check. The kitchen isn't built yet. You've got the guest list, the tickets sold, the ingredients stacked in a warehouse. What you don't have is a working stove. And when you call the contractor, he tells you construction is going to take years. Meanwhile, the fish in that warehouse has a shelf life measured in months, not years. That's not a hypothetical. That's the exact shape of the biggest bet in the American economy right now, and almost nobody is looking at the part that actually decides whether it works. Everyone's been trained to think the AI bubble, if it exists, is going to pop because the technology stops improving, or because a chatbot says something dumb, or because the valuations finally look too silly to justify. That's the story people are watching. It's the flashy part, the part you can put in a headline. And to be fair, the size of the bet backing that story is genuinely staggering. The largest technology companies in the world have been pouring hundreds of billions of dollars a year into building out artificial intelligence infrastructure, and that number has been climbing sharply year after year with no sign of slowing. A huge share of recent economic growth in the country has been quietly propped up by exactly this kind of spending. When something is carrying that much weight, it's natural to assume the crack, if one shows up, will come from inside the technology itself. But that's not where the real risk is sitting. The real risk isn't digital, it's physical, it's boring, it's concrete, copper wire, steel turbines, and permits sitting in a government filing cabinet. And boring things have a track record of being exactly what breaks expensive bets, because boring things don't care how exciting your story is. Here's the common mistake almost everyone makes when they think about a technology boom. They assume that if the demand is real, the supply will eventually catch up, because that's how it usually works with software. You want more users on an app? You rent more server space. Done in an afternoon. Digital things scale fast because digital things are just information moving around. But this boom isn't actually digital at its foundation. It's sitting on top of something extremely physical and extremely slow: the electric grid. And the grid does not care how much money you throw at it, because money can't rush a permit through City Hall, and money can't make a factory build a turbine any faster than its production line allows. So let's go back to the kitchen, because the kitchen is basically the power grid, and understanding how a kitchen actually gets built will tell you almost everything about why this boom might stall out. Before any commercial kitchen can turn on its stove, it needs to be connected to the actual utility, inspected, approved, wired in. In the world of power grids, that approval process is called an interconnection queue, and it is exactly what it sounds like: a waiting list to plug something enormous into the shared electrical system. Think of it like the line at the DMV, except instead of walking out with a new license in an afternoon, you might be standing in that line for the better part of a decade. As of this year, the amount of proposed power sitting in these American waiting lists has swollen past 2,600 gigawatts. To put that into perspective, that backlog alone is larger than every power plant currently operating in the entire country combined. The average project now takes close to 5 years just to get from application to actually turning on. And in some of the country's biggest data center hubs, like parts of Virginia, the wait has stretched past 7 years. Some large facilities are being told it could take over a decade. And it's not just the waiting list that's the problem. Even once you're near the front of the line, you still need the physical parts. A data center doesn't sip electricity gently the way an office building does, quiet on nights and weekends. It runs at full blast, every hour, every day, all year, like a factory that never clocks out. Feeding that kind of appetite requires specialized equipment that almost nobody can build quickly. Big transformers, the machines that step high-voltage electricity down to something usable, are now taking well over 3 years to manufacture and deliver, and that lead time keeps growing every year instead of shrinking. New transmission lines, the literal wires connecting power sources to the places that need them, take years on top of that because of permitting alone. In one of the fastest-growing regions for data center demand, requests for new, large-scale power connections hit nearly 200 gigawatts in a single opening quarter this year, which is roughly equal to the entire existing peak demand of that whole grid combined. That's not steady growth. That's everyone showing up to the kitchen door at once, all demanding a table tonight, in a restaurant that seats maybe a third of them. Now here's where it gets expensive, and where you start to feel it even if you've never thought about a data center in your life. Grids don't just sell electricity directly. Some of the largest ones also run something called a capacity auction, which sounds complicated but is really just an insurance policy. Once a year, the grid operator pays power plants to promise they'll be ready and available on the worst possible day, the kind of scorching August afternoon or brutal January freeze when everyone cranks their air conditioning or heating at the exact same time. The grid is basically saying, "We'll pay you a premium now, so you guarantee us backup later." For most of the last 20 years, that insurance policy was cheap, because electricity demand in America had barely grown in 2 decades. Then the data centers arrived, not gradually, but all at once, each one eating as much power as a small city and demanding it be guaranteed forever. In one recent auction covering a grid that serves over a dozen states and tens of millions of people, the price of that insurance jumped by more than 800% in a single cycle. Regulators panicked and capped how high the price was allowed to go, and then the very next auction hit that cap too, and the one after that. What looked like a temporary spike turned into the new normal. That bill doesn't stay with the tech companies. A meaningful chunk of it flows straight into ordinary household electric bills in states that have nothing to do with AI beyond hosting the buildings that run it. And when companies realize the kitchen genuinely cannot be finished on time, some of them stop waiting politely in line. A few have started building their own private power plants right next to their data centers, skipping the public grid entirely for at least part of their supply. Others are buying up older power plants that were scheduled to retire, paying to keep aging equipment running a little longer just to have something, anything, plugged in. It's the equivalent of a restaurant owner who can't get a commercial oven delivered in time, so he shows up with a camping stove and a folding table instead, telling guests the 5-star meal is still coming, just cooked a little differently than planned for now. It works, sort of, but it's not the scalable, elegant infrastructure the trillion-dollar bet was actually counting on. It's a patch, not a foundation. So that's the kitchen problem. Real demand, sold in advance, running into a physical construction timeline that simply cannot be rushed no matter how much cash gets thrown at it. But remember the fish in the warehouse, because that's the second half of this story, and it might actually be the scarier half. The ingredients in this analogy are the computer chips that actually run artificial intelligence. And chips have a strange, uncomfortable property. They age fast, really fast. A cutting-edge AI chip today is genuinely the best in the world for maybe 2 to 3 years before a faster, cheaper, more efficient generation replaces it and pushes the old one toward the bargain bin. Meanwhile, the building around that chip, the wiring, the cooling systems, the power infrastructure feeding it, is built to last for decades. So you end up with a strange mismatch. Ingredients that spoil like fresh fish, sitting inside a kitchen built like a cathedral meant to stand for 100 years. This mismatch isn't just a headache for engineers. It quietly shapes the profits that show up on quarterly earnings reports. And this is the part almost nobody outside of finance pays attention to. When a company buys expensive equipment, it doesn't count the entire cost as an expense the day it's purchased. Instead, accountants spread that cost out evenly across however many years the equipment is expected to remain useful. Stretch that assumed lifespan out longer, and the yearly cost on paper shrinks, which makes profits look bigger today. Shrink that assumed lifespan, and the yearly cost rises, which makes profits look smaller today. It's a single accounting estimate, a guess about how many years a chip stays useful, and that one guess is quietly worth tens of billions of dollars in reported profit across the industry. And here's the strange part. The companies making this guess don't even agree with each other, or with themselves over time. One major cloud provider extended the assumed life of its servers from 5 years to 6, which alone added billions to that year's reported profit. The very next year, that same company reversed the decision and shortened the assumption back down, citing the pace of change in AI as the reason. Meanwhile, a rival company was doing the exact opposite at the exact same time, stretching its own assumption longer, which quietly boosted its own earnings per share. Same technology, same year. Two accounting departments looking at identical silicon and landing on completely opposite conclusions. One well-known investor, the same person famous for correctly calling the housing crash years before it happened, has argued publicly that the entire industry is understating how fast these chips actually lose value, to the tune of well over $100 billion in overstated profits across just a few years. The companies involved push back hard, insisting their customers really do get 5 or 6 good years out of the hardware. Nobody outside the room actually knows who's right. But the disagreement itself tells you something important. Even the people running these companies aren't sure how long their own ingredients stay fresh. Think about what this actually means for a regular household budget for a second, because the logic is identical even if the dollar signs are smaller. Imagine you buy a laptop and decide, purely for the sake of your own budgeting, to pretend it'll still be your primary computer in 8 years. That assumption makes this year's expense look small and manageable. Now imagine your neighbor buys the exact same laptop and budgets as if it'll need replacing in 3 years, because that's realistically how fast technology actually moves. Same laptop, same price tag, two completely different pictures of how expensive this year really was. Multiply that gap by hundreds of billions of dollars in equipment, spread across the 5 or 6 largest companies on the stock market, the same companies sitting inside most ordinary retirement accounts through index funds, and you can see why one accounting assumption is capable of moving so much money around on paper without a single extra dollar actually changing hands. And there's a second, quieter layer sitting underneath even that. Recent analysis has surfaced that the largest cloud and AI companies have collectively signed hundreds of billions of dollars in data center leases that haven't even started yet. Commitments on paper for facilities not yet built, sitting off to the side where they don't fully show up on the balance sheet until the lease actually kicks in. That figure, once you add it up, is larger than all the existing debt those same companies currently carry combined. It's the equivalent of reserving and paying deposits for an enormous stack of future dinner parties before the kitchen for even the first one is finished. So step back and look at what you're actually holding. On one side, you have physical infrastructure that takes 5, 7, sometimes closer to 10 years to build, immovable no matter how much capital gets poured into it. On the other side, you have the core product sitting inside that infrastructure, aging out in 2 to 3 years, maybe stretched to 5 or 6 if the accounting assumptions are generous. Picture 2 clocks running in opposite directions. One measures how long it takes to build the kitchen, the other measures how long the fish stays edible. If those 2 timelines fall permanently out of sync, you end up with an uncomfortable outcome. Enormous, expensive kitchens, finished years late, built to cook ingredients that already spoiled while everyone was waiting on the contractor. Here's the deeper truth hiding underneath all of this, and it's the part that actually explains why brilliant, well-resourced people keep walking into it anyway. The bottleneck isn't happening because artificial intelligence is failing. It's happening precisely because it's succeeding. Real demand is what filled up the waiting list. Real demand is what triggered the parts shortage. Real demand is what's making every single ingredient. Suppliers suddenly become the most important company on Earth. Success is what broke the kitchen, not failure. And on the chip side, it's the same story flipped around. The technology keeps improving so quickly, generation after generation, that its own progress is what makes last year's model spoil early. The very thing that makes this technology genuinely impressive is the same thing quietly working against the timeline everyone is depending on. This is where money psychology sneaks in, because this pattern is not unique to artificial intelligence. Human beings are remarkably good at extrapolating exponential things and remarkably bad at respecting linear, physical, bureaucratic things. When you watch software improve, it feels like it can improve forever, faster and faster, because that's genuinely how digital progress often behaves. But the moment that digital progress needs to touch the physical world, a steel factory, a permitting office, a copper mine, a construction crew, it slams into a completely different kind of clock. Concrete cures at the same speed it always has. Permits get reviewed at the pace a government office reviews them. Turbine factories can only build so many turbines a year, no matter how large the order sitting on their desk is. And because most people, including plenty of sophisticated investors, spend their attention on the exciting exponential story and almost none of it on the boring linear bottleneck, the linear bottleneck is exactly the part that quietly decides how the story ends. It's the same reason people underestimate how long home renovations take, or how long it actually takes a promising new drug to clear regulatory approval, or how long it takes any ambitious plan to survive contact with plumbing, wiring, permits, and paperwork. The exciting part gets the headlines. The boring part gets the final word. There's a reason our brains work this way, and it's not a flaw unique to investors or tech executives. It's just how human intuition handles anything that grows exponentially instead of steadily. Picture folding an ordinary sheet of paper in half over and over. After a handful of folds, it barely feels any thicker. After 20 or 30 folds, if it were physically possible, that stack would be taller than most buildings on Earth. Our gut instinct is terrible at sensing that kind of curve until it's already happened, because for most of it, the growth looks slow and boring right up until the moment it suddenly doesn't. Artificial intelligence capability has been folding that paper at a genuinely stunning pace. But the grid, the turbines, the permitting offices, none of those fold. They add, slowly, one project at a time, the same way they always have. The mismatch between a folding curve and an adding line is exactly the gap this entire story is falling into. So what does this actually mean for you, someone who isn't running a data center or filing SEC paperwork, but who has money sitting somewhere, maybe in a retirement account, maybe in index funds that happen to be stuffed with the very companies making this exact bet? The takeaway isn't to panic, and it isn't to try and predict the exact week something breaks, because nobody, including the professionals making confident predictions on television, actually knows that with precision. The takeaway is a shift in the question you ask before getting excited about any fast-moving story, financial or otherwise. Instead of asking, how big can this get, start asking, what is the most boring, unglamorous constraint standing between here and there? Every genuinely exciting growth story eventually has to pass through something slow and physical: a supply chain, a regulator, a factory, a labor force, a legal system. The story rarely fails because the vision was wrong. It stalls because the boring bottleneck nobody wanted to research turned out to be load-bearing the entire time. That single habit, hunting for the unglamorous constraint instead of getting swept up in the exciting one, is one of the most useful filters you can apply to any investment, any business plan, any big financial decision that sounds too smooth on the surface. It's also a quiet argument for something you've probably heard 100 times and maybe tuned out: not putting all your financial future on one dazzling story, no matter how convincing that story sounds this year. Concentration feels smart when the story is working. It only reveals its cost later, when the boring bottleneck finally catches up to the exciting narrative. And by then, it's expensive to learn the lesson. Spreading your bets isn't a lack of conviction. It's an acknowledgement that even the smartest people in any room routinely underestimate how slowly the physical world moves. There's one more habit worth building alongside that, and it costs nothing but a little curiosity. When a company you're invested in, even passively through a fund, quietly changes an accounting assumption, like how many years its equipment is expected to last, that's usually treated as a footnote nobody reads. Start treating it instead as a headline. A stretched-out, useful life assumption isn't a crime, and it isn't automatically dishonest, but it is a genuine signal worth noticing, because it's one of the few places where a company is quietly telling you, in its own filings, how confident it really is that today's spending will still be paying off years from now. You don't need an accounting degree to notice the pattern. You just need to know that number exists and that it's worth glancing at once in a while, the same way you'd glance at the odometer before buying a used car. So think back to that dinner party one more time. The tickets are sold, the money's already spent, the ingredients are sitting in the warehouse, and the clock on their freshness started the moment they arrived. The kitchen contractor says it'll be done, eventually, just not on the timeline anyone hoped for. Nobody involved in this is lying, and nobody's necessarily wrong about the food being good. The danger was never that the dinner wouldn't be excellent. The danger was believing a kitchen could be built as fast as a guest list could be sold. The parts of the world that move at the speed of software will keep sprinting. The parts of the world that move at the speed of steel, concrete, and government paperwork will keep moving exactly as slowly as they always have. And history keeps showing us the same quiet lesson, again and again. It's rarely the flashy failure that ends the party early. It's the boring thing nobody was watching that decides when dinner actually gets served.